This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
We're going to look now at IFRS 15, dealing with the very important subject of revenue. Revenue or sales or turnover is a very political number, and businesses periodically overstate it. So the rules setting down principles on when revenue should be recognised are therefore very important. And it comes back to very basic things. So, for example, if an airline collects some money from a customer, and maybe the customer is due to fly 3 months later, when does the airline book the revenue? Do they book the revenue when actually they get the money or when the flight takes place? And the answer, of course, is at the time of performance, when the flight takes place. Does it make any difference if the flight is non-cancelable, so the customers lost their money? And the answer basically is no. It makes no difference whatsoever in almost all cases. So you book the revenue at the time of performance. That's the big message. IFRS 15 introduced a 5-stage model for revenue recognition, which you will have met when you studied financial reporting. So step 1, determine whether there is a contract. Step 2, decide what the obligations are under that contract. Step 3, understand what the price is. Step 4, if you know the obligations and you know the price, you can now allocate the obligations, the price to the obligations. And finally, as those obligations are satisfied, I can then book the revenue. So a nice logical approach. In many ways, though, I suppose it's what most reputable companies were doing before the standard was ever issued. So our notes go through those 5 steps with lots of examples. The first step is about identifying if there is a contract in the first place. Well, that goes back to your study of contract law in contract. So essentially, there's a contract, of course, if the two parties have agreed to enter into contract, but that does not normally need to be in writing, but they need to have approved the contract. And the key thing is that there's going to be a contract if you will probably get paid. You might say that you wouldn't enter a contract if you wouldn't probably get paid. I know, I wouldn't either. But if the question says they probably won't get paid, well, just, lie down and take it and effectively say, well, if they probably won't get paid, this is not a contract. At the end of the day, it's like some kind of gift, if you like. So step 1 is identify the contract. Step 2 is then to identify the obligations under the contract. These are the things that could be separately sold. So I know that in a fast food restaurant, if you're buying burger, fries and drink, that there's a package price, isn't there, for the burger, fries and drink, which is less than the separate price of burger, fries and drink. You can actually buy the burger without the fries or the drink without anything else and so on. Those are our performance obligations. So they are things which are distinct, and the key thing about them is look for things that could be sold alone. Then if they could be sold alone, then they need to be accounted for separately. Now, usually in scenarios, I don't think that's going to cause any real problem. But pause the tape for a minute and have a read of Livertech. So this business sells hardware, it supplies and installs software, and it provides a technical support package, one of those helplines that you phone up or email and they come back with the answer to your problem. So they sell them separately. In addition, you can buy them, a very common word is as a bundle. I think that's what games shops tend to say, buy this bundle of games. So there are effectively a series of separate performance obligations, and therefore they should be accounted for separately. So it might be that you wish to distinguish, for example, the installation of the software, recognize that once it's been installed, the provision of services would be over the period of the support service that you're given. A very common thing might be that you buy some equipment like a TV, and you also buy a guarantee for 3 years from the company that's selling it. They're separate performance obligations if they're separately sold, and so the income from each of them should be recognised separately. So stage 2 is decide what the obligations are. Stage 3 is sort out the price, and essentially, of course, the price, what you're really trying to do is to simply say, what is it that I'm most likely to receive? So what am I most likely to receive? Because it could be that the customer might get a volume rebate or something like that. So how likely is it that the rebate will be payable? Take that account. Lots of judgment, of course, but use your common sense to assess what you're most likely to be paid. Think about sometimes consideration might vary, depending again on the volume of stuff that people are buying. So what's the most likely amount of goods that I'm planning to sell? Think about sometimes where there's a big financing component, in which case that might need to be stripped out of the transaction. In the UK, there's a major chain of furniture shops, and one of their big selling points is they say they give customers 4 years interest-free credit. Now, of course, it's a marketing tool, it's fine. So there's no such thing as interest-free credit, is there? Unless it's from your mum or your dad or your brother or your sister. So yes, you'll be paying a different price because of this so-called interest-free credit. And the company that's booking the revenue needs to separate out that price. Pause the recording and have a read of example 1, and then we can play with the numbers. So this company sells the car for 10,000. You don't need to pay for 3 years. I don't think I'd offer that. I'd be worried about them running away with the car. But anyway, normally interest rate is 5%. It needs discounting to present value. When we do that, again, so we're going to have to do some discounting to present value. So we need to do that to measure the consideration really at much more of a fair value. So we'll see how that works over the 3 years of the contract. If you went to that particular seller and said, I want to pay cash today, would you pay the same price? I'm sure you wouldn't. You'd pay a lower price, essentially. So we're just saying, separate out the streams of income. This is partly a car seller and partly almost a bank providing finance. So if we think about that transaction over the 3 years, so this is playing around with the numbers in example 1. Time 0 is going to be the date of sale when the customer collects the car. Time 1 is 1 year later. Time 2, 1 year later. Time 3, 1 year later. So we're doing more here than the requirement says, but just to think around this transaction. So in the balance sheet, there'll be a soft P, So a receivable right until time 3. In the profit and loss, the first thing is you will get the revenue from the sale of the car. Discount that in the first year. So I think this was $10,000. It is a 3-year arrangement, normal interest rates, 5%. So 10,000, 5%, 3 years. So I would book revenue on the actual transfer of the car. If I round, I think that comes out as 8638 with a corresponding receivable. That's the date, again, when the car is delivered from the customer to the customer. So this is when the car is given to the customer. Now, over the next 3 years, that so-called discount will unwind. So we will therefore get finance income. So 1 year later, we can start to unwind the discount. 5% of 8638 is 432. So the receivable goes up to 9070. The next year, of course, will continue compounding. 5% of 9070, 454. The receivable goes up to 9524. And finally, in the third year, 5% of 9524, 476. The receivable is 10,000. So it's beautiful. I sometimes think it's like art, isn't it? So we create a beautiful thing in the profit and loss as we show those 2 performance obligations. The 2 performance obligations are to supply a car and to give credit. I suspect that the giving of the credit, the finance income, would be shown further down the profit and loss as opposed to on the revenue line. Because I think my primary activity is I'm a car seller. Step 1, identify the contract. Step 2, identify the performance obligations. Step 3, identify the price. Step 4, if you've got a series of obligations and a single price, we now need to allocate the price to the obligations. And again, if given no other information, as it says here, use the standalone selling price of each of the products that we're offering. Pause the recording, please, and read example 2. So because they've bought the bundle, they're going to get revenue of 10,000. If the customer had bought these things separately, they would have got revenue of 11. So I need to allocate again the revenue I'm actually receiving to the 2 performance obligations based on the standalone selling prices. The standalone selling prices are highlighted in blue. The bundle price is highlighted in yellow. So I'll need to do a little bit of a working to sort that out. I can see this is over 2 years. Just to try and think about this for a moment, let's just think about the accounts. I'm focusing on the profit and loss account. I'm saying, look, what would happen in year 1 and what would happen in year 2? Well, there are 2 streams of revenue. There's the sale of goods, which is the home entertainment system, and there's also the provision of services. So I'll need to do a working using the standalone prices. If you're good at maths, you may not need to do a big working, but it's probably easier in case you go wrong for the marker in your exam. So I'm looking at the standalone price, and I'm looking at the bundle price. Can I call it a bundle? Well, I have. The bundle price. First, there's the goods, and then the services. The standalone price of the goods is 9,000 and the services is 2,000. I'm looking there at the blue numbers. That's 11,000. The bundle price, let me highlight those in the same colour, which was blue. The bundle price is 10,000 for this lucky customer. So I need to allocate and prorate based on the standalone prices. So essentially I need to allocate that 10,000. And so what's going to happen is that 9/11ths of the 10,000 will be for the goods, and 2/11ths of the 10,000 will be for the services. 9/11ths for the goods, 2/11ths for the services. So if I prorate that, I think that's 8182. And 1818. So on the date the customer gets the goods, I will book the 8182. The services are to be provided over 2 years. So it's a 2-year maintenance package, so I'll recognise half each year. So each year I'll recognise 1818 over 2. 1818 would be 909 in the first year and 909 in the second year. Now, it's worth saying as well, perhaps, that's the position in the profit and loss. What is happening in the soft P? Well, in this case, my assumption is the customer is paying up front. So you will have some deferred income. Historically, this has been known as deferred income. It seems to me now that the politically correct word to use, though, is contract liability. So at the end of the first year, so if you're calling it deferred income, I'm not going to throw my toys out the pram. In the first year, you've received 10,000. 8182 and 909 have gone to profit and loss. The other 909 will sit in deferred income. As I say, this is normally, again, expressed now as contract liability. It is a credit balance, don't forget. So it's in the liability section. It's in the liability section of the SOFP. Stage 1, is there a contract? Stage 2, performance obligations. Stage 3, the price. Stage 4, allocate the price to the performance obligations. And that will bring us in just a minute across to step 5. When do we recognise the revenue? So there are two possibilities, essentially goods and services. Rather than say goods and services now, they say make a distinction between revenue that is recognised at a point in time and revenue that is recognised, this will be across the page, over time. So in other words, sometimes it's appropriate to recognise at one point in time, sometimes it's appropriate to recognise over a period of time. So let's just highlight that. For point in time and over a period of time. If it's a point in time, it comes back to all the words you've learned ever since you were 4 years old. Transfer of risks and rewards, transfer of control, transfer of title, who takes insurance responsibility. Those are all of the considerations that you would have in mind. So essentially, again, if it's a single point in time, transfer of title, physical possession, a very important word is transfer of control, risks and rewards of ownership. Frequently in scenarios, we might be engaged to build something for a customer and the customer pays a deposit, but the customer doesn't really get access and control until the end of the contract. And that presumably would then be the time when you would normally consider recognising the revenue. So that is a point in time. Now let me just jump a little bit in terms of the notes. If on the other hand, it is over a period of time, then you have to think when assessing revenue, how complete the contract actually is. There are lots of different methods to do this, but principally, you could look at the amount of revenue that you've earned or the amount of the costs that you've incurred. So if you look at the amount of revenue that you've earned, it's sometimes known as the output method. If you've looked at the amount of the costs incurred, it's sometimes used as the input method. But really, they're giving very posh names to very basic concepts. So if you're doing something for a customer where you think it's appropriate to recognise the revenue over a period of time, then a common sense one is to look at the revenue approach. So consider how much work has been done to date as a percentage of the total contract revenue. So this word work certified, again, this would be something that you would find out from something like a surveyor or independent arbitrator would say, this is the value of what you've done today. Or, as I said, you could look at the costs and compare them to the total costs. All sorts of possibilities there. Now, on this page, you will see, if you look above, example 3 and example 4, there are good answers to those in the back of the notes. I'm not going to go through them because they are so similar to the one that we did in the last example. So, they work in exactly the same way, where you are simply allocating the revenue against the performance obligation. So I'm not going to go through those, but I will say a very brief word in a moment about example 5 which is some kind of building contract, and for some reason they've decided it's appropriate to recognise the revenue over time. Just looking at some of the figures that we've got there, we're told that the contract value is 45. We're told that the costs incurred are 20. The cost to complete are 12. So how much revenue should I therefore recognise? Well, I could use that output method, the input method, the costs, and say, to date, I could say the total costs that I've incurred are 20. The costs to complete are 12. So I've incurred 20 to date. The total costs are 20 plus 12. That's 32. 20 over 32 times 45 would give me, I think, revenue, if I round it, of 28. So that would be the revenue that would have been booked to date, just over a period of time. 5-stage model then: identify the contract, its obligations and the price, allocate the price to the obligations, and recognise the revenue as the performance obligation is satisfied. And what I might do just back here is just kind of write that in bold. So what we need to ask about with recognition of revenue is essentially, I'm just going to write it back here. Recognise revenue as, here's the key word, the performance obligation is satisfied. So there's a review of the 5-stage revenue model. In the notes, there are a couple of other points that are made. Let me just come forward there. There we are. Couple of specifics, which are probably things you've seen before, but we'll mention briefly. Principle of the agent. So if you book your honeymoon at a travel agent, the travel agent will of course only take the commission, and that should be their revenue. The travel agent is not the person in the hotel who makes your bed and puts chocolates on your pillow. The travel agent should not book all of the revenue. They should simply book their commission. So we have to be careful and just distinguish, is it a principal or an agent? It's very common sense, but many companies might wickedly pretend to be principal instead of agent so that they make their revenue look bigger. Because often at a business meeting, people would say, what is your revenue? And if it sounds enormous, then of course it sounds like you're dealing with a big company. Repurchase agreement. Well, if you sell something and then you've agreed to buy it back again, that sounds like a loan, doesn't it? So there's a company called Birdseye that makes, I don't know if you've come across this product, fish fingers. If they sell their fish fingers to HSBC and then buy them back again, it's not because the bank staff like fish fingers, it's a loan secured on inventory. So in some circumstances, if you are required to repurchase what you've so-called sold, then the commercial substance is that it's a loan secured on inventory, not revenue. A final piece of jargon to recognise, very common in the motor trade, is consignment stock. If I make cars, then the car dealer, I transfer some cars to the car dealer on consignment. He may or she may or may not be required to buy them, but frequently they have the chance to send them back to me if they can't then send them to their customers. They don't have the working capital to buy all these expensive cars and then wait for a customer to wander in. So it begs the question, doesn't it? Are they my cars or the dealer's cars at that stage? And again, we would look at the substance of the transaction. So essentially, again, we would consider things like who bears the significant risk and reward of ownership. Very often, I tell students to look for things like insurance cover. Who's got the insurance responsibility if the cars are all stolen? There we are. There's a recap of revenue, the 5-stage model that may well form part of the exam. Examiner has said, please don't write out the whole model, just pick the bits that would be relevant in the scenario, but I'm sure we can do that.